Welcome back. Well, the markets are, actually recovered a little bit from the lows of the day. So we're holding around that 18,100 odd. The Nifty Bank is actually doing a relative outperformance in today's trading session. But let's go across to our next corporate. Then the Indian logistics and warehousing sector has emerged as a significant space over the last few years. But rising fuel cost, high operating cost are a few headwinds for the sector. In fact, Blue Dart in December 2022 announced price hikes of around 9.5%. Mr. Gambhir, the CFO of the company, joins us on the show. Hi, Mr. Gambhir. Good morning, and wishing you and your team a good 2023, since this is the first time we're speaking this year. I wanted to talk about business, but first tell us about, we've been hearing about some strikes in Punjab as well as in Himachal Pradesh. That's particularly the truck unions. Any impact on business as of now? Could you tell us what's your analysis of this?
So good morning to you, and thank you for your wishes. As far as strike is concerned, I think Blue Dart has, as in the past, has handled such situations very well, and generally such kind of transportation strike does not impact much, because we are slightly in different business as compared to normal transportation. We are in express business, which is time-bound service. So generally that does not see impact of such a strike.
Okay, all right. So that's good news if it's not impacting your business, Mr. Gambhir. But tell us about demand. There has been various reports that suggest there is some softening of demand post the festive season. Are you observing the same in your business?
So yes, as you rightly mentioned, in fact, many people have been talking about slowdown, and that is coming from global economic indicators. But in India, currently, what we are seeing is slight softness in demand, post-festive season. Rather, it has started slightly before festive season, but then that's a softness probably is coming after a very long spell of good volume growth. So probably it is demand is taking a pause and may come back soon. That's what we expect.
Okay, so demand is taking a pause and may come back soon. Do you think you have announced enough price hikes in order to support your margins? I think until December you had announced about 10% price hikes. Any more that you'd have to take? And since demand is coming back, you think you can pass on these prices to consumers?
So what we have been doing is to take care of inflation. So we have been taking price hike. We announced that much in advance. So like you rightly mentioned, we had announced towards end of September a price hike of 9.6%, which last 3-4 years has been the same trend. And that helps us in ensuring that whatever inflation happens, we pass on to our customers, and that does not impact our margin. So going forward also, like in this year, 2023, would see a similar kind of impact what we've seen in the past.
Mr. Gambhir, e-com is what percentage of your total revenue, sir?
So it's one of the largest vertical for us in terms of volume and revenue.
How much is it?
So roughly it'll be about 1/4 of it, the top line.
I see. And no, but is there a slowdown? Can you talk to us about that?
Yeah, as I just mentioned that we have seen one of the longest spell of good growth even in e-commerce vertical. Right now that is also experiencing some softness. I won't call it a slowdown.
Okay, and would you say the same about other segments as well?
Yes, similar trend.
A soft patch.
That's right. Yeah.
Right, and but you don't think this will be protracted? Do you have visibility that things will pick up? I mean, just trying to understand.
So our expectation is, given the resilience in Indian economy and the reports which you are reading, that slowdown may not impact India as much. So we expect that demand to maybe after some softness it may come back, because our economy is generally driven by domestic consumption. And I don't see consumption going down to that level of which will show as more of a slowdown. That's why we're calling at this point of time a softness. But yes, we will keep a watch on this, and as and when we see bigger impact, probably we'll update on that.
Okay. Can you tell us a little bit about the market share? What is the current market share of Blue Dart?
So market share actually is generally by the kind of service which is offered. So we continue to remain market leader. on air.
Okay.
And on ground side also, we have made a good stride, and strong growth of last few years have put us in almost number 2 position as far as ground is concerned.
Okay, so on air, you all are the market leaders, and number 2 position on ground. I'm asking because there is a lot of competition, I guess, you're facing from domestic air carriers, startups, rail and road transport as well. Has it affected your market share in any way?
In fact, if you see, we would have gained market share in recent past because of better service quality. As I have been earlier mentioning about that Blue Dart is focused more on customer centricity and delivering high service quality. Right now, our service quality has been the best, and as a result, we have been gaining market share. But yes, at this point of time, probably studies are happening post-pandemic. Once the numbers are known, probably it can be circulated for knowing that what has been the gain in the market share.
Mr. Gambhir, Amazon, there was a recent kind of event where they outlined their plans for Amazon Air, right? They've set up a dedicated freighter service. Any thoughts on that in terms of how it may impact your business with them or otherwise?
So in any case, as you mentioned that they have done it for dedicated their in-house logistics.
Yes.
So when in-house is already there in-house and is not getting outsourced, so impact would not be there much from that arrangement. But as far as we are concerned, we are in time-bound delivery service, which is door to door. I think putting a network, which is network is one part of the network. I think the entire thing needs to be seen from an end-to-end service point of view, and how much service delivery you do on time. That's what matters in this business.
Okay, so tell me, you have a total of over 700 stores right now. What is the opportunity that you see in terms of store opening? How many do you plan to open, say, over the next 1 to 2 years? I think in the near future, you've mentioned you're targeting 100 more stores. But in the next 1 to 2 years, what is the potential?
So as you rightly mentioned that we have been focusing more, expanding our footprint more on the retail side. So we have recently also added about 25 stores, and another 100 stores are likely to get open in a year's time. And further plan would be to further have our footprint expanded on the retail side, which becomes addition to the margin. So that would help us in maintaining and improving margin, and that's the idea of keep increasing retail footprint.
All right, Mr. Gambhir, thank you very much. Good speaking with you. Appreciate you joining in with all of that. Well, the market's down about 60 points, so nothing new in that sense, but lots of stocks moving around, which we'll refer to. 18,100. On to our special segment, Quarter Se Quarter Tak. Nigel has walked across to the big wall, and we're going to talk about expectations from the steel sector in the third quarter. Nigel, over to you.
Well, the ferrous space will get some shine back, but not glittering as yet. That's for the third quarter. The steel sector earnings, they have fallen considerably after peaking out in the second quarter of FY22. That's because a combination of factors: weak demand, weak pricing, as well as higher coking coal costs. Now, after a gap of 4 quarters, the estimate is that the sector EBITDA per ton will finally start showing some improvement. Well, let's run you through the key factors at play for the ferrous industry. Realizations, they're expected to decline by around 2 to around 3% odd on a sequential basis. That'll be roughly around 1,500 rupees per ton sequentially. That's led by price cuts as well as contract resets during the past quarter. Raw material costs, well, they'll cool sequentially, which will aid non-integrated players in particular to a large extent. Coking coal costs, they're expected to decline by around $80 to around $100 per ton, while iron ore costs can decline by around 500 to around 750 rupees per ton. The volume growth is estimated at around 13% on a year-on-year basis during the quarter, led by a low base despite weak exports. There will also be close to around a 4,000 rupee per ton quarter-on-quarter recovery in steel margins in the third quarter, but it will still be almost half at what it was in the same quarter last year. On an EBITDA per ton basis, well, JSW Steel will deliver the biggest jump on a sequential basis, followed by SAIL, Tata Steel, as well as JSPL. But Tata Steel Europe, well, they'll struggle. They expect to report a loss led by a significant drop in prices as well as weak demand. That's what will impact their product mix. Valuation-wise, well, should come up for you on the screen, but as we know, the EBITDA part of that business, well, that fluctuates. Hence, there'll be greater focus on the price to book value, which for ferrous names, well, the price to book value is pretty much in line with what we have seen in the past averages. For metals, we know that momentum is more important. Moving ahead, the most critical element will be China reopening and also the Chinese government stimulus. That's what could aid the real estate sector out there and in turn aid steel demand. Coming back home, well, the pickup in domestic demand will be tracked as restocking takes place. Additional volumes can improve as export avenues reopens while prices are higher as well. But some part of that price increases, well, they'll be offset by higher raw material cost as well. To help us understand what do we expect from the sector in the coming quarter, well, we have Amit Dixit, analyst at ICICI Securities, who joins us. Hi, Amit. Thanks so much for joining in. Well, before we get to the quarterly expectations, wanted to ask you, what is the current price difference between imported steel and domestic steel? I understand there have been a couple of price increases in the last 2 months here in India. Go ahead.
Yeah, so if you look at the price difference with respect to China, we are at 5% discount. With respect to South Korea, particularly after Nippon Steel has increased prices for March deliveries by a hefty $150 per ton, we are again back at discount. So clearly there is an element of discount of around 8% over there. So there is definitely a headroom for domestic players to increase prices, provided demand in domestic market sustains.
Okay, all right. So some kind of cushion for the domestic players. I recall in November, we were at a premium. So there is a discount, then it gives some scope for price increase. At least we can hold on to these levels. Well, Amit, I wanted to ask you about your preference from the ferrous space itself. We have 4 large listed players. We have a brokerage note today coming in from another sell-side brokerage, which believes that SAIL is well placed. For you, from the top 4, what is your preference out there, and tell us why?
Yeah, so our clear preference in the sector is JSPL. We have a buy only on JSPL out of 4 major names. Rest are either hold or reduce. And the reason being that, see, we go by the cost, first of all, the cost. The second is in terms of demand, what we believe that longs typically will fare well in the fourth quarter, and there we see demand creeping up. So definitely JSPL is well placed. As far as SAIL is concerned, well, from the risk reward perspective, we don't see much benefit over there. Although I would say that the higher iron ore cost in the country would definitely benefit integrated players like SAIL and Tata Steel. But given the fact that coking coal prices have started rising up, and this typically impacts SAIL more than the other players. So in fact, in the period we were talking about, from October till now, coking coal prices have risen from $240 to $300 a ton. And that would progressively get reflected in the P&L. So as a result, the spreads of companies like SAIL might not materially improve despite the improvement in prices that we see over here. On the other hand, JSPL is it is dependent for part of its capacity on the thermal coal, as well as they have a natural hedge for coking coal from their own mines in Australia. So there we see the benefit a little bit more.
Okay. Since you do believe that there is headroom for domestic prices to go up, as well as, perhaps demand is also picking up, on JSW Steel, what are your thoughts? What kind of upside do you see in the near term, and what are the triggers?
Well, as far as JSW Steel is concerned, see, provided if the domestic demand picks up, this company is best placed. The reason being they have a spare capacity. However, 2 things here. One is that I think we are being too optimistic on China at this stage. It all depends on how the policy pans out after Chinese New Year. And moreover, if you look at Chinese indicators, look at housing starts, look at the new area purchased for sales, or even look at the aggregate financing numbers. These were lower than expectations. So clearly, for any policy to sail through, it will take at least 3 to 6 months. So my point here is that the global factors might not play out as people are expecting. The second point that goes against JSW, unfortunately, is the high level of debt, relatively high level of debt. So if prices were to slide from here, I mean JSW would be a disadvantage. And the third and the final thing is that in case of JSW, we also see valuations. I mean, they are at an absolute high if you compare to the other peers, as well as its own trading average over last 10, 15 years, whatever time frame you take. So we believe from a risk reward perspective, things are not that, I would say, attractive over there. But at the same time, in terms of EBITDA growth, well, the company can show EBITDA growth because it has got enough headroom to ramp up volumes.
All right, Amit, just moving a little away from the ferrous space, I wanted to ask you about the stainless steel place. And you have been quite positive on JSL and JSL Hisar. The stock has seen a big run from the recent lows. How much of it is already in the price? Are you already considering the merger, in the numbers that you've put in?
So the numbers we cover only JSL, so the numbers
Yes.
are not with the merged entity.
Okay.
However, what we believe that the merger, the benefits of merger, I think some of it have or are already priced in the stock. The second big benefit, though, that people often choose to ignore is the acquisition of the stake in JUSL. I believe that will bump up EBITDA per ton by roughly 3,000 to 3,500 rupees a ton. And since we are talking about JSL, I would expect actually EBITDA per ton springing back again to 18,000 from 15,000 odd in last quarter. So I think that is positive. And then we also expect sales volume to be at around 285 KT, led by the inventory that was built up in last quarter. So clearly these are the highest volume ever. And we believe that in case of JSL, there is another upside for at least to 15 to 20% hike from here. And then if you look at the merged entity, the benefit with JUSL, some of it will pan out, of course, in FY25. I believe you have got pretty good headroom over there.
Okay, I wanted your thoughts on APL Apollo as well. A lot of brokerages recently raised their earnings estimates and target prices on the stock. There's also their Raipur plant that will start contributing now. So are you optimistic here, and what kind of an upside do you see in the near term?
Yeah, so as far as APL Apollo is concerned, we believe that EBITDA per ton will come back to 4,000 rupees a ton in this quarter. Their sales volume was like an all-time high in this quarter, and more importantly, the product mix that we observe has become richer, courtesy Raipur plant stabilizing and ramping up. We believe that this particular plant, which has capacity of 1 million ton, as it will stabilize and ramp up in the quarters to come, the product mix will get even more richer, and therefore EBITDA per ton will creep gradually to around 5,000 rupees a ton. A key critical factor is that the acceptance of larger diameter pipes in the market that the company produces, and the Raipur plant definitely produces that kind of a product. So we would wait and see the kind of acceptance that happens for these product. But overall, we are quite positive on the stock. One thing very positive from the stock perspective is that it is a downstream player, so relatively immune to the movement in the HRC prices because it's a kind of converter business. So that gives us additional comfort.
Okay, Amit, final question then, not a company specific, but more sector specific. The rebar prices are trading at a premium in comparison to HRC. You expecting this to sustain? And, what should the normal level be, the difference between both these two?
Yeah, so historically, what we have seen that the difference between rebar and HRC has been around 4,000 rupees a ton, give or take few hundred rupees here and there. And HRC has traded at a premium. The reason why rebars are trading at a premium there are two reasons. One is that, as we all know, Hockey World Cup is happening in Odisha. So lot of sponge iron facilities have been actually shut down for the month of January. And therefore, this provides impetus to secondary rebar prices, which is also reflected in primary rebars. That is point number one. Point number two, we have seen rebar prices sustaining for quite a good period of time. The reason being that the demand is more local in nature, while in case of HRC, prices are pegged to international markets. Having said that, international prices in HRC have moved up by almost 15 to 20% since November. So HRC will play a catch-up game, and we expect that as Q4 flows, we expect that this thing to normalize by Q1, and rebar prices, while they will increase, the increase could be lower than case of HRC, and there could be a discount of roughly 2,000 rupees a ton between HRC and rebar.
That's interesting. I mean, hockey in Orissa and rebar prices. I mean, the connection. Thank you very much. Interesting conversation. Interesting listening to you, Amit, as always. Thank you for joining us.
But very good point, actually, by Amit, because normally the HRC prices trade at a premium comparison to the bars.
Yeah.
Bars are used more domestically for construction, etc. But suddenly, it's flipped around. And now you have rebar prices that are trading at a premium. Many years, I've never ever seen this. So good logic out there. Some of those sponge companies, they have shut down facilities, which is resulting in some bit of a scarcity in the secondary market, getting passed on to the primary market, and also more domestic demand driven. So that's why. So interesting point.
Okay. Well, for the market, market is sort of stabilized around that 18,000 mark. And to be honest, it's not such a bad showing compared to what we woke up to with a 600-point fall on the Dow. The Nifty is just down about 60-odd points. Mitesh Thakkar joins in now. Mitesh, do you see the dips getting bought through the course of the day? And are you optimistic now? I mean, do you see this uptrend that we've seen over the last many days? Do you see it continue? And what are the stocks to look at for the rest of the day?
So my sense is that I think, this dip will get bought into sometime during the day. I think maybe, because I'm not expecting the levels of 18,000 to be broken. So maybe another 30, 40 points down, we might get a low, which could be the low for the day. And then we should pick up again from there. So still trading with more of positive bias. In fact, I have 2 buy calls as the market is still weak. UPL is breaking out very nicely with good jump in volume. So keep a stop at about 732 here. And on the upside, 770, 775 is the target range. The other one is persistent systems. Good price volume action in the first hour of the trade. So that's the buy. Keep a stop at about 40 here and a target of around 41.50 on the upside. Can we look at that?
UPL, right, Mitesh? Mitesh, the first one was UPL, right?
That's right. UPL, United
Okay.
Phosphorus.
All right, that's the one. Okay, 744 on UPL. UPL and Persistent are the 2 trades from Mitesh. 70 points lower. I just want to highlight a few other names before we take that break. And look at Nykaa, for example. Nykaa is seeing a bit of a recovery today. So the low on Nykaa today was 126, and we are back at about 132 right now. So that is seeing some turn. Sula went to being absolute. It started strong, went to being absolutely flat, but there is momentum there, definitely at lower levels. I'm talking about lower intraday, wherever there is a bit of pullback. Buying comes back 3.5 once again after yesterday's 6% move. This week, Sula is up 28%, 30% actually. Sula. Hindustan Zinc is doing well, 2%, follow through after yesterday. And there is PTC, which is up a full 5% at about 106 odd rupees at this point in time. Anything additional? Maybe Credit Access is another name which was not there in the mix earlier. 4% higher on Credit Access. That's the top-rated MFI company. Moltech is up 10%. Again, only mentioning this because volumes are there for the taking. And RK Forging, Mahindra CIE, some of the other auto and companies with about 2.5% kind of gains as well. So lots happening in the broader market. The Nifty is one leg more lower, 80 points lower on the index. We'll take a quick break here. Manisha joins in with the focus on the commodity markets and what's happening. Stay tuned for that.
All right, let's take a breather from equities and look a little bit at the commodity markets. Manisha is here to tell us more about that. Manisha, what's the one commodity you're looking at this morning?
Well, I'm looking at the overall sector, Sonia, because a breather is exactly what the commodities rally also seems to be taking at this point in time. So most of the commodities have come off their 2023 highs as of now. We did see a big run up without a meaningful correction, and that's exactly what the markets have seen in last 12 to 14 hours. Copper prices, after declining a percentage point yesterday, have a percentage point decline right now. It is because the dollar strength has come back. We're trading above 102 right now. So that really seems to have led to some decline in many of these dollar-denominated commodities. Also, all the economic data that we've seen coming from Japan, China and US has been on the weaker side. The US retail sales have declined the most since April 2020. The US industrial production has declined for a second straight month and the lowest since April 2022 yet again for this one. And then the markets also have seen the US key Fed officials talk about higher interest rates for a longer period period of time. And the most two important key officials have said that last evening is what is really weighing on across commodities. So as you can see, many of these metal prices have continued to decline. The other major factor comes in from China, and much of the buying really came in because China was reopening and buying. But China is headed for a week-long holiday in the next week, and the physical demand ahead of that also seems to have slowed down. That's weighing onto the prices. Profit taking also after a very strong opening in 2023 seems to be hurting the markets here. So as I said, most of the energy markets, base metal prices, industrial metals, precious metals, all of that have seen a decline. Copper, aluminum, zinc, all of them are still trading near to their 7-month highs. Actually, in case of copper, we've seen nearly 8 to 9% of gains in 2023, and copper prices have gained 32% in last 6 months. So some bit of a pause, consolidation, a meaningful correction is what the street perhaps will be looking at. But not just metals, the gold and silver prices have declined quite sharply overnight. Yesterday morning, same time, we were trading at 19.20. We're just about holding at 19.10 right now. Silver prices have declined below $24 per ounce as well. And when you look at the crude oil prices, they slipped quite sharply too. We did see 82 for the US crude and 88 for the Brent crude oil prices. So from 88, below 84 is how that one is trading. While we have seen statements from OPEC and IEA suggesting that the global consumption can pick up in this year, mainly because of China, but the weak economic data and the fact that you have seen a surprise build-up in US inventories are all weighing factors here.
Okay, thanks a lot for that. Well, let's get back to equities because there's plenty buzzing right now. Adani Enterprises is one of the top losers in trade. If you want to know more, Vivek is here to give us the latest. Vivek, over to you.
Well, that's right. So Adani Enterprises, the massive fund mobilization that they're doing via the FPO route, 20,000 crore is what the company is looking to raise via this particular route. And, they've gone ahead and given the details as to the timelines as well as the price band, and that is what is weighing down on the stock. So the opening date of this particular FPO is on Jan 27th. It will run up till 31st of January, and the anchor investment date is on 25th of January. Now, what is interesting is the issue price band. The lower end of the price band is at 3,112, and the upper end is at 3,276, which implies a significant 9% discount to yesterday's closing price. Also, on top of that, the retail participants, that are people who will be investing less than 2 lakhs, are getting a further 64 rupees discount on this particular FPO. Now, what is it that the company is raising funds for? Green hydrogen, airports, and greenfield expressway projects. The company will invest over 10,000 crore from this particular FPO proceeds, and over 4,000 crores will be used to repay debt in their various subsidiaries.
All right, Adani is seeing a bit of a knock, 4% lower. Vivek, thank you very much for that. Persistent Systems has turned around. Rima is here to shine the spotlight once again on that name. Rima, hi.
Hi, thanks so much for that. So the top line growth for Persistent has actually come in at the upper end of what the analysts were anticipating. A dollar revenue growth of 3.4%, 3.5% in constant currency terms. As I said, this is slightly ahead or at the top end of what the analysts were anticipating. And this performance comes despite high furloughs, which impacted them in the current quarter. Margins have been a positive surprise. Margins expanding by nearly 80 basis points to 15.4%. versus expectation of flat margins. That's a positive. The deal wins for the company have been steady. The current deal wins, or in Q3 FY23, were nearly at $239 million, higher than the average over the last 4 quarters. Attrition has moderated for the 4th consecutive quarter, and it currently stands at 21.6%. The only worry, or something that we need to watch, is the top client contribution. Now, the top client revenues have fallen by 12% quarter on quarter, 43% lower on a year-on-year basis. This is something the company had spoken about last quarter. It was a planned ramp down of the client, but does it end in the current quarter? Does it continue in the subsequent quarters? That is something that the street will be watching very carefully. But on the whole, despite high furloughs, the seasonal weakness, Persistent has delivered a good showing. Back to you.
All right, thanks a lot for that. 3.5% higher, very good set of numbers. Let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will connect with Neeraj Gambhir of Axis Bank and Suyash Chaudhary of IDFC AMC to discuss the outlook for rates and yields for 2023. Stay tuned.